Ladies and gentlemen, boy, do I have an exciting one for you guys today. Really fitting for your Saturday afternoon. In this video, we're going to talk specifically Tesla, what you need to know about September seasonal weakness in this upcoming week, my thoughts and expectations around what's next for Tesla. But we're also going to take a listen to what Tom Lee says about this market and what 13 research Warren Pies says about this market. Warren Pies has been one of the most spot on fund managers I've seen in a long time. He called out the correction or crash that we would have in the beginning of this year. Turned out to be a 20% crash. He called the recovery, and well, now you're going to hear what he says next for markets. He says it's a bull market, but the risk is we get a little bit too much weakening in the economy, which is a little bit of a different take, I would say, from Warren Pies. So we got a lot to get into here in today's episode. Hit that like button as well as subscribe to the channel if you have not done so already. If you guys want to come join the trading community as well, check that link out down below in the description of this video. We did make a new trade on a brand new stock on Friday, and I'm quite excited about it, with a full research piece coming out over this weekend, either tonight or tomorrow. So come check it out if you'd like to. But with that said, let's get into today's episode. So first things first, I do want to play these clips from Tom Lee and Warren Pies here for you, and then discuss Tesla in the back half of this video, because I think you should hear the context first. So take a listen.
For a winning week with all three major averages on track for another record close. Let's bring in 314 Research co-founder Warren Pies. Warren, thank you for being here. I guess you're sticking with your 2025 S&P target of 6,800. That's about 2% from current levels. So do you think all the gains for the year essentially are captured or reflected at these levels?
We had that coming into the year, and there were times when it looked like a really optimistic target, and now it's looking a little bit less optimistic, but we're going to stick with that. We are going to stick with that. But I do think the big takeaway from the Fed this week is that, there were two, I'd say, big positive developments for the equity market, which at least gives you the hope and the reason why you want to stay long in a bull market. And number one is that there was conventional wisdom that the rates market, so the short-term rates market, had priced in significantly more cuts than what the Fed had signaled back in June. And so this put a high bar for the Fed to clear. This was the reasoning out there among traders. And when you study those instances where we've had that before, where there's a great expectation for the Fed, and then what happens next? The Fed moves a little bit towards the market, not all the way. It's actually very positive for equities in the quarter ahead. We saw that last September. We had the market rally over 8% the next quarter. And then we also saw that December of 2023. So that's the first thing I think that gives you hope as an equity bull. And then the second thing is the Fed, the bottom line through all the confusion of the SEP is that the Fed is basically lowering their real Fed funds rate. So that's the nominal Fed funds rate minus their projection for interest rates across every year, 2025, 2026, 2027. Rates are getting lower given their forecast for inflation. You don't want to be underweight equities in that environment.
So then what would you be doing from a portfolio allocation standpoint to, if the market does achieve that 6,800 target by year end, would you be adding to equities now? Would you be waiting for some sort of a pullback to add to equities? Kind of how are you thinking about portfolio construction against that backdrop?
Yeah, that's the thing. We're risk managers. So we're always wondering, we might be bullish, but we're always looking for risks. We're paranoid by nature. And so when we look out at the rest of the year, where does the risk come from? A lot of people are worried about the bond market. A lot of people are worried about inflation and a reacceleration of the economy. That's not our big concern. Our big concern is that there's some kind of a growth scare waiting out there for us. I think there's about let's call it a 1/3 chance that we hit a growth scare over the next few months. And that would be rough for the equity market. It would probably be, if you go back and study those in history, like a 7-8% pullback and more volatility in the equity market. And that would be offset by a rally in the bond market. And so, in my mind, if you're an equity investor, you want to press your longs into year end, which is what we're doing. You want to pair that with an overweight bond position. So that's how we're positioned. My best guess is that if we had that growth scare, you'd see the 10-year get down below 3.5, which I know sounds outlandish right now. But that's not our base case. But I think that it's a higher probability than what the market expects, and so that's how we are currently positioned in our portfolios.
Yeah, 10-year around 4.1 now. What do you mean by growth scare? Is that a sentiment indicator? Is that, specific hard data that you're looking at? And, how do equities, as you've studied throughout history, how do they typically respond in instances of a growth scare?
Yeah, growth scare is kind of a thing you hear people throw around. I think it's a good question because people throw it around, they don't really define it. My view as a growth scare is when there starts to be anxiety around a recession that never materializes. Usually you see the unemployment rate pop up a little bit and then settle back down. These, when we study history, and you have a good chart here from our report, when you study history, these kind of occur around soft landing. So we're in this soft landing, muddle through economy right now, where the Fed's trying to land the plane, and then all of a sudden you have some kind of fear around the soft landing not going the way the Fed wants it. So we saw this in the mid 60s. We saw this in the mid 80s, a growth scare. We saw it in 1995. There was a growth scare. People probably forget that. 2018, also another soft landing. We saw a growth scare. And then we had one last year. If people remember, we had a big rally in the bond market, a little bit of a sell-off last August. And that is a classic growth scare type of pattern. So that's what you'd expect. You see rates come down, you see the yield curve flat, you see unemployment rate pop up a little bit, but not enough to trigger things like the SOM rule. And then you get equities. They still perform when you zoom out, but just more volatility. So you end up having like a 7-8% drawdown within the context of a growth scare. And so, again, I think we're in this muddle through soft landing, but if you're trying to prepare yourself for risks, the risk is much more that we're going to worry about the growth. And I think that's what the Fed saw. There's so many questions around the Fed SEP and how do you square a higher inflation rate with a lower Fed funds rate, lower unemployment next year with a lower Fed funds rate. I think the Fed sees a bigger left tail for the labor market. They're more worried. You heard it in Powell's comments in the press conference. They're more worried than they want to let on about the labor market. And I think you need to prepare your portfolio for that.
Yeah, all about risk management right now, both at the Fed and for you, Warren. Thank you so much for your time today.
Tom Lee of Fundstrat is with us. Tom, welcome. You can comment on all those moves or anything else if you'd like, but also I want you to comment on something that hedge fund billionaire David Tepper said on Squawk Box this morning. Listen.
I don't think another ease matters, as far as being too easy. It's going to be a little bit restrictive, or even if they do two. Beyond that, it's going to be a little tricky, I think, because you got to be careful not to make things too hot to have the other side of the mountain, which was really freaking ugly, in 2000, in 2001, etc.
All right, so let's bring in Tom Lee, not the drummer. Tom, what do you make? I mean, how much does the Fed really matter to the equity markets right now?
The Fed still matters a lot because they are the most powerful institution in the world. And it matters because monetary policy relatively tight has kept the ISM below 50 for 31 months. And so corporate America has operated with a bit of caution, keeping the car in low gear because they didn't know where inflation was going to be and they didn't know where monetary policy was. So I think when the Fed begins to ease, it's not just a move in interest rates, but it's a green light for corporations to get more confident. And as you know, the ISM moving above 50 does not only revive economic activity, it probably also rejuvenates the labor market, which has been sluggish for what looks like more than 12 months.
So does that mean if the Fed stays dovish or keeps cutting, that there's other newer legs to this pretty remarkable stock rally?
Yes, and I might even say that I think that we could have growth recover without inflationary pressures. I think reflexively, people the last few years think growth picking up means there's automatic inflation. That has not been the case for 25 years. But I think if companies begin to expand, plus the fact that we know AI is driving productivity gains, and that's really a big tailwind for businesses, and then we know that there's initiatives around Wall Street boosting productivity because they're going to build on the blockchain, I think there's a path for growth to be stronger next year without a pickup in inflation. That's going to be very good for profits and for equities.
Yeah, and listen, we've talked about many times, Tom, and I know you've talked about it with Scott and others as well. You've been long, you've been strong, you've been correct. But is there, at some point, does this market take a breather? It's getting, listen, as a 401k holder, I like it. But as a TV analyst who's been doing this for almost 30 years, I'm starting to worry about it a little bit.
Yes, I mean, a pullback is going to be inevitable. But from a timing perspective, sentiment still remains staunchly negative. So, I think that the gold standard is the AAII net bulls less bears. That's been 6 consecutive weeks where it's negative. That's never really marked a market top. I mean, that has to flip positive and sustain for several weeks. So I think if we're going to say between now and year end, could the market pull back? I'd say it's possible, but to me, it's probably from higher levels. I think there was a lot of skepticism about even yesterday's FOMC. I had a lot of clients tell us they thought the stock market would sell off because 25 was priced in. But because almost everyone told me that, that was the consensus view. I think people were cautious into yesterday. And that's why we're seeing the groups that should rally big, like the small caps and the cryptos and the financials and even the Mag 7.
We might even get a record high for the Russell 2000, about, 75, 80 minutes left to go. We'll see what happens. Tom Lee, we're going to let you go, but always appreciate you coming on, Tom. Thank you.
So when it comes to September seasonal weakness, okay, next week is kind of like the last week of that. It does technically extend into the Monday and Tuesday trading day of the following week, technically. But in October, we're going to be heading into seasonal strength from a historical perspective in markets. October, November, December are very strong periods. Now, the whole growth scare thing is something we really need to watch, because I've started to see some anecdotal evidence of the labor market weakening, maybe a little bit more than I previously thought. I've heard some people say it's hard to get a job, that people have not found it this hard to get a job in a while. We are heading into the holiday season, and maybe there's a little bit of a lull, right? End of summer before holidays have really started to kick off. So I'm not reading into it too much, but I do think we are at one of those moments where we don't want to be like panicking. Like, I'm not hedging my portfolio or anything like that, but I am very vigilant for a risk event, okay? If we were to get some big fallout in trade, or perhaps a government shutdown could, I don't think that's a recession-like catalyst, but it's definitely not good, right? I'm on the lookout for these risk events, these big negative catalysts, okay, or shock events. If we get one of those, that sets us up with a problem. It's impossible to forecast that. There's intuitively a low odds of that happening at any given time, but that is the risk. If we do get some kind of shock to the economy that pushes us into a recession. The fact of the matter is the U.S. economy does not just go into a recession. So if we were to get some kind of growth scare, I'm going to be buying that, as long as there is not some kind of growth or like a economic shock attached to it, right? That would be a solid buying opportunity. And honestly, I hope we get a little bit of a growth scare, like give us a little bit of a discount in stocks. That would be nice. I do think things are setting up well into next year. Okay, I think the next 3 months could be a very strong market, as long as we don't have a big negative event happen. Okay, I think specifically for Tesla, things are setting up really well, okay, with some of the recent news. The analyst price target, now $548 per share, the highest price target on Wall Street from Bard and from analyst Ben Callow. I think that really puts Tesla on notice by hedge funds and institutions, money managers. They're like, whoa, Tesla, the leader in physical real-world AI, That's big, right? Something we've known for a while, but Wall Street is coming around to that idea. So as long as nothing dramatic happens, I think we're gonna have a very strong rally. There's also a part of me that thinks back to the rolling recession that we've had for a while now, where it was certain areas at certain times, right? It was real estate, it was autos, it was home improvements like Home Depot, right? Went through quite a rolling recession. Consumer, maybe it's a little bit in the labor market now, but is it enough to cause massive layoffs in which you need to get a recession? No, it just doesn't. That doesn't look likely. We do get initial jobless claims. That is a very leading indicator of weakness in the labor market. 2 weeks ago, it was 260,000. Last week, it was 230,000. So it actually went down last week. And that's something I do want to pay a little bit more attention to over the next couple of weeks. Okay? Because just because we're heading into a strong seasonal period doesn't mean it's guaranteed to be strong. Right? That's important context to point out. But there's a lot of bears out there. There is a lot of bears out there. In the AI investor sentiment survey, over 40% of people are bullish, over 40% of people are bearish, and like 20% of people are neutral. Like, the bears are high, bulls are high, and there's not a lot of people in the middle. With having so many bears on our markets, it's going to continue to fuel the upside in stocks, and specifically around a stock like Tesla, where there are so many people that are bearish in Tesla that are finally starting to come around, to the stock, the company maybe being this leader in AI. The news today, Robotaxi has gotten approval to begin testing in Arizona, for an example. We're going to get a lot of catalysts like that over the coming months. And it's going to boost Tesla stock into the end of the year. Anywhere from $500 to $600-ish is in the cards by the end of this year for Tesla, as long as nothing goes dramatically wrong. And again, I don't think something will, but I am on the lookout for that, as kind of Warren Pies said, as kind of risk management. Part of managing risk is being realistic, right? Ray Dalio became the largest hedge fund, Deepwater became the largest hedge fund in the world because he was realistic. He understood like market cycles and patterns and being realistic, right? What's going to happen? You got to predict the future if you're managing money. And right now, the odds are definitely favored towards we're going to have a very strong market. But if things change, you do not want to be so bullish that you miss it. And I will not be that guy that is so bullish that I miss the change in the tides, right? I'm not going to stand on the beach while the tide goes out. I know what that means. I know that means a damn tsunami is coming, right? If I start to see that tide going out, I will let you guys know. But as of right now, things look pretty damn good. Pretty damn good. I will say that. And I'm positioned for a big rally in Tesla stock into the end of this year. So hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of today's episode. Have a great rest of your day, and I will see you in the next one.